You see it in the headlines all the time, right? Geopolitical tensions are always bubbling up somewhere, and that puts the super volatile relationship between energy prices and our financial markets right back in the spotlight. And, it brings up a huge question for one of the biggest assets out there. Okay, let's dive into this.
And this really is the multi-billion-dollar question we're going to try and unpack. When a major oil shock hits the system and sends markets into a total frenzy, does Bitcoin just sink along with all the other risky assets? Or does it become that digital lifeboat that investors are desperately looking for?
The trigger for this can be almost anything. Just think about it. Coordinated strikes on a major oil producer, or maybe even drone attacks that spook insurance companies so much that tanker traffic through a critical choke point like the Strait of Hormuz just completely collapses. These kinds of events don't just nudge oil prices, they can send them absolutely skyrocketing, and that creates this wave of uncertainty all across the globe. So when you think about oil and Bitcoin together, your mind probably jumps to one place first: all the energy it takes to mine it. It just feels intuitive, doesn't it? But let's take a closer look at that common assumption. Yeah, the thinking usually goes something like this. Oil prices shoot up, so that must mean electricity gets more expensive everywhere. And since we all know Bitcoin mining uses a ton of electricity, well, the miners' profits must get totally crushed. It seems like a really simple, direct connection. But is it actually the whole story? This is where we really have to dig into the data. I mean, if that assumption is true, then a pretty big chunk of the global mining network has to be running on power grids that are directly tied to the price of crude oil. So is that really the case? Well, what's so fascinating is how this chart just completely flips that script. According to data from Hashrate Index, about 90%, that's 90, of the Bitcoin network is powered by sources that are pretty much insulated from what crude oil prices are doing. We're talking about massive hydro operations in places like Paraguay and Canada, or natural gas and coal in the US and Russia, and even geothermal in Iceland. In fact, the slice of the network that's genuinely exposed to what crude oil is doing is, well, it's tiny. We're talking somewhere between 6 and 10% of the entire global hash rate. And that's mostly concentrated in places like the Gulf states, the UAE, and Oman, where their grids are way more directly linked to oil. So that direct impact on mining costs, it's really contained to a very, very small piece of the puzzle. Okay, so if the direct cost of mining isn't the main event here, we have to look deeper. The real connection is actually much bigger, and it has a lot less to do with miners' electricity bills and a whole lot more to do with a massive economic shockwave. Let's trace how that actually works. And this lays out the chain reaction perfectly. It starts with some geopolitical event that sparks an oil spike. That spike then feeds directly into inflation and just general economic fear. So what happens next? Central banks might jack up interest rates, and investors all over the world basically hit the panic button. They go risk off, which means they start selling assets they see as volatile or speculative. And lately, that has definitely included Bitcoin, putting major downward pressure on its price. This quote from Hashrate Index just absolutely nails it. See, the crucial point here is that the real danger to a Bitcoin miner isn't a tiny little increase in their power cost. The real risk is their revenue getting slashed by 20, 30, or even 40% because the price of Bitcoin itself just fell off a cliff. The danger comes from the revenue side, not the cost side. And all of this really forces a fundamental conflict right to the surface. In a crisis that's fueled by inflation and uncertainty, Bitcoin gets pulled in two completely opposite directions at the same time. So on one hand, Bitcoin often trades like a high-risk tech stock. When the markets get scared, it tends to sell off right along with other speculative assets. But on the other hand, you have the whole digital gold narrative. With its fixed supply of just 21 million coins ever, it's seen as a potential hedge against the exact same inflation that an oil shock creates. It's decentralized, and it lives outside the traditional system that's in turmoil. So which way does the price actually go? Well, it's not some law of physics. It really is a battle of stories. Bitcoin's direction during an oil shock depends entirely on which of these two very powerful narratives convinces more investors to either buy it or sell it. So, how do we track this battle in real time? Well, there are a few key signals you can monitor to get a sense of which way the market is leaning at any given moment. First, keep an eye on the source of the tension itself, like shipping traffic in the Strait of Hormuz. Then watch the official data, like oil inventories and those big CPI inflation reports.
Pay really close attention to what central banks are doing with interest rates. And finally, watch Bitcoin's correlation to tech stocks. If you see that correlation start to break, it could be a sign that the digital gold narrative is actually starting to win out. Which brings us to the ultimate question, doesn't it? The next time a crisis sends oil prices soaring, will the market treat Bitcoin as just another risky tech stock to be dumped, or will it finally, truly embrace its role as the ultimate safe haven in a digital age? The real story? Well, it's still being written.